Hey, good evening, everyone. Got a few folks here. I see we got more pouring in here. I just wanted to welcome everyone and thank everybody for tuning in this evening. You got a couple of us here from the firm here tonight. I think I probably know most of the folks signed up, but if not, I'm Greg Dahlberg, one of the advisors here with the firm. We've got Logan here, kind of running the helm here. He's going to be in charge of control. So as we go through the PowerPoint to the webinar this evening, you should see a taskbar or a toolbar at the bottom of your screen. If you do have questions, feel free to send them in, and Logan will kind of field them as we go. We're going to try to hold off questions till the end, so we can kind of get through the presentation here. And when we get done, we will open up for some questions and answers and answer anything that you guys have going on. Again, I'd like to thank everybody for showing up tonight. This is, I think, our third call this year. We've been looking to add something, just some additional outside perspective. We're kind of blessed through our affiliations with our broker-dealer, LPL Financial, and some of the fund companies that we work with to be able to access, some top talent in the industry outside of our office, and like to just kind of keep information in front of you. And we've reached out to one of the fund companies, and our presenter tonight, I'll introduce to you here. His name is Dan Braz. Dan is with State Street Investments. He's our ETF specialist, global head of sector specialist at State Street Investments, based out of Boston, so out east. But I understand he's got some Michigan ties here. We're just chatting. Dan leads the team responsible for providing investment strategy and market insights for State Street's clients globally. He's been in the industry since 2001. Dan, looks like you got your MBA from Kellogg School of Management in Northwestern University, and you are also a CFA, or Chartered Financial Analyst. So I'd like to thank Dan for giving us his time this evening. I'm not going to keep everyone real long tonight. Dan's got some slides he's going to kind of walk through, and we got questions. We are meeting with clients in our office all day, every day. Dan and clients have questions on markets and midterms and oil prices and conflicts and AI and all these buzzwords we're hearing. And we just thought it'd be good to reach out and kind of pick your brain, get some insight, see what's kind of happening behind the scenes, and what the folks at State Street are thinking. And with that, I'll go ahead and turn it over to you. And then, yeah, if anyone's got questions, feel free to send those into Logan, and when Dan wraps up, we'll walk through those. So
great. Thanks so much, Greg and Logan. I really appreciate the opportunity to be here and spend the evening with everybody. As Greg mentioned, my name is Dan Braz. I'm based out of Boston. I always like to apologize right off the bat, because when I tell people I'm from Boston, they're often very disappointed that I don't have the accent. So I actually am from Boston, but somehow I avoided the Boston accent. So I guess that's good. You'll be able to understand me here tonight. But I've been with State Street Investment Management for a little over 13 years now. And State Street's a name some of you may be familiar with us. Some of you may not. They're actually the biggest bank in the Northeast, or at least in New England. And we're actually the second oldest financial institution in the country. A lot of people don't know that about us, but we've been on a really long time. We go back to 1792, literally on the road, State Street, here in Boston. And kind of a fun fact that whenever a new bank is chartered anywhere in the country, the governor of the state has to sign the bank charter, making it official. And the State Street Bank Charter was actually signed by John Hancock, the John Hancock, who was the governor of Massachusetts back then. Yeah. So we have really deep roots, and we started as what's known as a custody bank, which, for those of you who've been investing a long time, if you think back to a while back, it used to be when you bought a company, say you bought a railroad share, you would actually get a physical certificate. Sometimes you'll see people hang them on the wall. They're kind of anachronistic now, but that's how it used to be. If you had that physical share, that meant you owned a part of a company. Well, think about how cumbersome that would be for big institutions who are constantly trading stocks. They don't want to have to track paper. So they literally kept the physical share at State Street Bank and Trust. We held onto it. We kept track of who owned the actual share. And it just made the entire capital markets work a lot more efficiently. These days, as you can imagine, it's all digital. But we custody, that's called custody, holding onto it. We custody somewhere around $50 trillion globally. Something like 15% of all the assets in the world are custodied by State Street. So, it's an organization I'm very proud to be a part of. We're also the creators of the world's first ETFs. So those of you that know what ETFs are and invest in ETFs, we brought to market the very first one, the S&P 500, back in 1993. and now there are tens of trillions of dollars in ETFs globally. So I'm very proud to be part of this organization. We currently manage my group somewhere around $6 trillion. And the way I describe my role is that my job is basically to look over the shoulder of a lot of really smart people here in Boston at our headquarters. We have all these different teams doing all sorts of different investment styles. Some of them are picking stocks, some are picking bonds, some are thinking more about the macro global economy. And it's fun for me. I get to sit in on their meetings, I get to listen to them debate with each other. And I work really closely with folks like Greg and Logan to share our views on where do we think things are going in the economy and markets? Where are we placing bets on our own portfolios? And we're here to kind of bring the resources of a multi-trillion-dollar organization to their practice. So one of the things we do every 6 months, we sit down and we try to figure out what are the economic indicators that we are going to be most focused on for the next 3 to 6 months. And we put together a presentation. I'm actually going to share it in just a moment here. And I thought that's what I'd do for the next 15, 20 minutes. I'd share with you what are the things we are thinking about, because there's so much data out there. There's so much information. Sometimes you need to narrow it down. And for us, in any given moment, there's certain trends in the market that are really ultimately driving where the stock market's going to go next. And if you can sort of figure out what are those data points that are most important right now, it can give us some insights into where things are going. So I'm sharing my screen here. Hopefully it's coming up.
Yep.
Looks like it came up there. Excellent. So we put this together not long ago, just in June. And again, this is for the second half of the year. We always like to come up with a tagline. What's sort of a summary of like how we're thinking about the markets right now? And we came up with resilient fundamentals, rising fragility. Fragility is a reference to all this volatility with oil prices. Maybe that's behind us, maybe it's not. Oil going up is obviously not good for the economy. So that is something we have to watch, right? So there's some fragility if oil goes too high. I would argue, though, the most important word here, though, is resilient. Our economy has been unbelievably resilient, really this whole decade. If you think about all the things our economy's had thrown at it, things that we've never experienced before, obviously a pandemic, unprecedented amounts of stimulus, huge inflation, big changes in interest rates. All these things have happened, yet our economy just keeps growing slow and steady in a really efficient way. And the stock market's done phenomenally well. And to us, it's a reminder that the natural state of a free market economy is growth, right? If nothing from the outside is slowing things down, we should expect growth. We should expect a strong stock market. So that's a wonderful thing. And that still is in place, as we'll show in a moment. And we think that's an important backdrop. There's always stuff to worry about. Things are never perfect, but the underlying strength and trend line of the economy is just really good, and it's continued to just show a lot of resilience. So as I said, look, things are never perfect, right? There's always things that we are watching. So let's start with a couple things that are imperfect, and then we'll move on to more of the good news. So I'm going to jump ahead. I'll start by saying some of these slides are a little complicated. Bear with me. I'll talk you through them. Don't strain your eyes because there's a lot going on some of these. But I want to start by looking at this slide here in the chart on the left. You'll see it says US. You'll see a blue bar pointing down a little bit and a green bar pointing up. What is this saying? This is just saying that recently that blue bar is saying that they have downgraded economic growth for this full year just a little bit here in the US. It's not terrible, but instead of getting 3.5% type growth, we might get more like 3%. And again, when you have volatility in oil prices, that tends to happen. Yeah, not the end of the world, but it does show that there is some cost to having volatility in oil. The green line sticking up is saying that inflation expectations have actually jumped a little bit. They were expecting about 0.8% more inflation than we were before. Again, not the end of the world. Inflation clearly is past the worst that we're going to experience, right? Several years ago, we had 9% inflation. That's not coming back. If you hear the policymakers in Washington, though, they'd like to see inflation somewhere around 2%. Right now, it's at about 3.3%. 3.3% inflation is not terrible, but it is a little bit high. It's a little bit higher than they'd like. And two things seem to be driving it. One is the volatility in oil, but that maybe has already come and gone. The other thing is that for whatever reason, after all that inflation post-COVID, inflation went all the way back down to about 3%, and it just stopped going down. Normally, we would expect it to go back to 2%, and then we'd be back to normal. It just seemed to stick around 3% for some reason. Inflation's been what we call sticky. Not entirely clear why. The Fed's doing a lot of research. Maybe it's tariffs, maybe it's just consumer expectations. But that's why you might hear in the media, there's actually talk about the Fed maybe raising rates again this year. We'll talk more about that in a minute. We're not convinced it's going to happen, but that's why. Inflation's not terrible, but it's not quite back where they want it. And we do think they want to nudge inflation a little bit lower, and raising rates might be a way to do that. So this kind of busy chart on the right here actually looks at that. If you look at this dark blue line at the bottom, what this is showing is what the market thinks the Federal Reserve in Washington is going to do with interest rates. So if you look at the blue line and you look all the way on the left, you'll see December 25th. So that's Christmas. If we rewind the clock, we just go back to last Christmas. What this is saying is that the market thought the Fed was going to cut rates twice this year, maybe even three. Cutting rates is what the Fed does when they want to stimulate the economy. Cutting rates is what you do when you're not worried about inflation. So we came into this year and everybody thought, oh, the Fed's probably going to cut rates a couple times this year. If you follow the dark blue line, it stayed right around there. And then right when the conflict in the Middle East started in February, that line shot up to zero. All of a sudden, the market said, you know what? The Fed's not going to cut rates this year. They're not going to do anything. If you keep following the blue line, you'll notice now it's up over 1. Right now, the market actually thinks that the Fed is probably going to raise rates once, maybe twice between now and the end of the year. We at State Street are actually not convinced they're going to do that. We're not that worried about inflation. Our hope is that oil will stay at low levels here and not spike again. If that's the case, that alone will probably bring inflation down a little bit. So we'll see. But right now, the market thinks the Fed may actually raise rates this year, which wouldn't be the end of the world, but we're just not sure it's necessary. So our official view is that we don't think they will raise rates, and we frankly don't think they need to, and that the economy is strong enough and that inflation is still moderated enough that it's unnecessary. So time will tell. What else are we looking at? I was just talking a little bit about inflation, and it is true that inflation's running a little bit hotter than they would like. And looking over here, I want you to look at this blue line. The blue line is the regular inflation rate. And again, you can see here's COVID, this big spike in the middle, it went all the way to 9%, and then it dropped. And you can see what I was saying, how it's kind of stopped going down. It's kind of stopped right around 3%. And then all the way on the right, you can see that little blue pyramid there. That's that recent spike of inflation, probably driven by oil. And oil's already come back down, and you can see that blue line's going back down again. So that's why we're not that concerned about inflation becoming terrible. But this is what the Fed is looking at. This is what the folks in Washington are watching, and they want to make sure that inflation doesn't come back. That's their job, is to keep inflation down. So if that blue line keeps going down, if the inflation data keeps coming in lower and lower, that's a really good sign. That means the Fed might not have to raise rates, and the stock market would probably really like that. So again, when we think about things that keep us up at night right now, I'd say what's going to happen next with oil, what's going to happen with inflation, that's where there's some uncertainty. All that said, we're not that concerned because there's a lot of extremely positive things happening right now that we think are more powerful factors driving things forward rather than any kind of negative that we see. And one of the big ones that I'm sure won't surprise anybody is all the investment in AI. I will tell you, nobody knows whether we're overdoing it with AI in terms of the amount of money going into it, but we'll worry about that in the future. Right now, it's really good for our economy. If you look on this table on the left here, you'll see it says 765. That is $765 billion that have been invested in all these AI data centers just this year. That is a staggering amount of money. And, lots of these big tech companies have a lot of cash. They're super profitable and they're investing in AI. They don't want to be left behind. So we're talking, if you look at the forecasts here, over the next 5 years, they expect there to be $1.6 trillion invested in AI. And, I personally think AI is amazing. I've probably used it a dozen times today already. I think it will be interesting to see whether the companies make enough profit from AI to justify all this spending. But probably over the next couple of years, that'll be a big test. But in the near term, all this money being invested in AI is very stimulative and it creates, real opportunity. And again, even when there's things to worry about when it comes to the economy, this is a real positive. Another area that we're seeing opportunity right now probably won't surprise anybody. Unfortunately, defense spending is an opportunity from an investment perspective right now. If you look at this blue line, this is showing the percentage of companies globally that spend more than 2% of their GDP on the military. You can see the number was going down, 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 really since like the early 90s. Most countries around the world were spending less and less on defense spending. It's starting to bump back up. More and more countries around the world, for better or for worse, are investing in defense. And that does create stimulus, it does create spending, and it can create opportunities in the equity markets. This is a trend that we think is probably going to last for the foreseeable future. So whenever you see big investment, whether it's in defense or AI, these are very stimulative for the economy. And again, even if inflation's a little too high or oil's a little too high, these other positive forces right now appear to be much stronger, which is why we continue to see very solid growth and a very strong equity stock market. So one question that we often get is, where should we be allocating right now? And there's no simple answer to that when it comes to the stock market, but I thought this was a pretty interesting chart. This one on the left, you'll see, a black line. And what this is showing you is what's cheaper, big companies or small companies? I think all of you would agree. Any of you that follow the stock market probably know that for a long time now, about 15 years, large tech companies have just been the place to be. And they're getting bigger and bigger and bigger, and they're kind of leaving everybody behind. Maybe that'll continue, maybe not. It's really hard to know. But what this is showing is that whenever the black line is going up, that means that small companies are getting more expensive and large companies are getting cheaper. So if the line is going up, big companies are cheap. You'll notice the line's going down. What this is saying is smaller companies are the cheapest they have been in about 2 decades. Big companies have gotten bigger and bigger and bigger. Small companies haven't done poorly, but they haven't grown as fast. And what that means is you can buy smaller US companies much cheaper than you can, the big tech names that we all know. Doesn't mean you shouldn't own both, but what we find is that a lot of investors these days just don't have a lot of small companies. Historically, small companies make up somewhere around 15% of the US stock market. 15%. Today, they're 8%. So the bigger companies have gotten bigger, smaller companies have been sort of left behind. One thing I've learned over the years with investing is that whenever there's an extreme like that, it usually reverts, right? Things like to come back into balance. Small companies probably aren't going to stay this cheap for forever. So we're encouraging people to just look at their portfolio, maybe see if they want to, if it makes sense for their particular goals to have more in smaller and mid-cap size companies. And it's just something that most people are underweight right now. And we think there's an opportunity. When something's really cheaper than it's been in 20 years, I get excited and it makes me wonder if I want more of that in my portfolio. And then finally, quickly we'll talk about bonds. And again, a lot going on in this chart. I want to look at this dark blue line. This is what we call the yield curve. So what this is saying is that if you want to lend money to the government for 3 months, right now you can get about a 3.8% yield. It's actually not terrible. Still is, ahead of inflation, which is good. If you want to lend the government money for 2 years, you get a 4.18 yield. Well, that's pretty good. And what you'll notice is this line kind of goes up and to the right. That's actually a good thing. That makes sense. The longer you lend somebody money for, the better yield you should get from them, right? The more interest they should pay you. So this should be longer. The longer you're lending them money, the better rate that you get. Believe it or not, that's actually not how bonds have worked for a lot of the last 5 or 6 years. For a long time, this line was flatter. Now it is becoming what we call steeper. That's actually a good sign. That typically happens when the market thinks the economy is going to grow. I will say there's one thing we do want to watch here a little bit. If you just look at this blue line, you'll notice, all right, it's going up at sort of a steady rate, roughly, and all of a sudden it kind of spikes. And this is saying, yeah, if you want to, if the government wants to borrow money for 20 years, they have to pay almost 5%. People are saying, we want a higher rate if we're going to give you money for 20 years. We don't have it on the chart, but if the government wanted to borrow money for 30 years, the number is all the way up at about 5.2. In fact, the yield on 30-year bonds right now is the highest it's been in like 3 or 4 decades. What does all this mean? It does mean that maybe investors are starting to kind of question our budget deficits. And they're saying, you know what, short term, they're probably not that big of a problem, but eventually you got to pay your bills. And if you keep running up your debt, like at this rate, at some point in the next 20 or 30 years, we could have some problems when we have a hard time paying people back. So the longer the government borrows money for right now, the higher the rate they're having to pay, but it's becoming kind of amplified. And it might be temporary, but it is something to watch. The government doesn't want to find itself in a position where it has to pay too much to borrow money. And it could be the market saying, all right, these deficits aren't sustainable. You got some time, but you better find a more sustainable path. So time will tell on that. In general, though, looking at like 10 years or less, a slow upward slope is actually a good sign that the market thinks the economy will keep growing. So we'll take that as a positive. So Logan and Greg, maybe I'll pause there. Not sure if any questions came in or if there's anything specific that would be helpful for me to address.
Yeah, we got some questions there, Logan.
Yep. Yeah, I can handle that. Yeah, thank you, Dan. And I would say you kind of mentioned going back a couple slides about like small caps and mid caps being undervalued today. That's kind of the importance of making a diversified allocation, because in any allocation, you're going to have winners, losers. Things will happen that you think will happen, and sometimes you're wrong and it doesn't happen. So we can see mid caps and small caps are undervalued today. But who knows when that trend is really going to revert. That's why it's important to kind of make a diversified allocation, which we're big believers in. Question. So I have a question here. So you kind of touched on interest rates and inflation and what the market's looking at. And does State Street have an official view on what you guys think the Fed is going to do for the rest of the year as far as rate cuts or maybe rate hikes? Or do you think maybe cut it in the middle and they'll just stay flat for the rest of the year, and kind of how that could tie into a recession at all? I know recession was kind of a bigger talk earlier in the year, and that talk has died down a bit, but maybe how interest rates and recession risk kind of play together and what your guys' view is on that.
Yeah, absolutely. So, whenever the Fed raises rates, that would tend to slow the economy down a little bit. Whenever the Fed lowers rates, that's when they want to stimulate a little bit. And, if they were worried about it in a recession, they would be talking about cutting rates. That's not at all what they're talking about, right? If they thought there was any chance of a recession, they would not be even considering raising rates. So we'll take that as a positive. Again, the underlying trends are really good. What's interesting is there's a free website published by the Fed in Washington that every time new economic data gets released, maybe once a week, they update their forecast for economic growth for the current quarter. And I was actually just looking at it this morning. So Q2, right, that ended in June, looks like it's going to be probably a little bit of a mediocre quarter. We might have economic growth somewhere between 1.5% and 2%. Not terrible, but not great. That's a reflection of that spike in oil prices, slowing things down just a little bit. The good news, though, is typically when you have a quarter of mediocre economic growth, sometimes you get a little bit of a bounce back next quarter. So here we are, we're roughly halfway through Q3. Right now, believe it or not, the Fed is forecasting economic growth in this quarter of 5.8%, which would be phenomenal growth. Full disclosure, I don't think it'll end up being that high. But what it's saying is that we've actually had some really good economic data come in this quarter so far. Just in manufacturing data came in really strong. Some of the jobs numbers were good. So it looks like Q2 might be mediocre growth. It's looking like Q3 may actually end up offsetting it with really above average growth. So the good news is we really don't think a recession's anywhere on the table right now. It's nothing that we're worried about. It's nothing the Fed is worried about. And our official view is that we hope we get strong growth and inflation keeps coming down, in which case the Fed doesn't have to do anything. They don't have to raise rates. They don't have to cut. We can just let the economy do what it's continuing to do.
Thank you. Next up, you kind of touched on those mid caps and small caps for this question, but what area of the market are you guys seeing that may be overlooked right now, or do you think we should take a closer look at right now?
Yeah, there's another one that is very much on our radar right now that no one's talking much about, but it's emerging market equities. Countries like China, Taiwan, India, Brazil. It's been a long time. It's been about 15 years since they frankly have done much. But I'll show you a chart here. They are also super cheap. Is this the one? Yeah, so if you look on the right, this blue line, the lower the line, the cheaper emerging market stocks. So for those of you who've been investing a long time, you may remember about 20 years ago, emerging markets were really popular. And you look at this blue line, it went straight up, and emerging market stocks got really really expensive. They have now just gone straight down relative to the US for like 25 years. So right now, emerging market companies are about 30 to 35% cheaper than the US. And a lot of people haven't noticed this, but over the past 12 months, emerging market companies have been the #1 performing investment, almost twice as good as the big tech companies here in the US. So, at some point, people are starting to notice, we're starting to see a little bit of money go there again. But it's just an area that a lot of people just gave up on. It's not in their portfolio at all. But to your point, Logan, it's really important to be diversified. That's why you always want to own stuff, even if you're not sure it's the right moment, because sometimes it'll have a good run when you least expect it. Emerging markets right now finally have some momentum, and they're still really, really cheap. So we think they're just, an important piece of a portfolio. It's nothing that you want too much in, but it's kind of a nice thing to sprinkle in.
Got it. Thank you. Looks like last question here. Switching gears a little bit. So we have midterms coming up. Historically, how have midterms impacted markets, and what is State Street's view on, depending on how midterms go one way or one party or the other, how that could impact markets going forward?
Yeah, it's a great question. So just this morning, I was actually chatting with my research team, and we're getting ready a massive amount of work around what to expect from the midterms and what that'll mean for the markets. So I'll give you a little bit of a sneak preview. The good news is anytime there's either a midterm election or even a presidential election, you almost always get a rally in the market afterwards. And it's because it's a removal of uncertainty, right? Markets don't like uncertainty. So once they know who won, regardless of the outcome, you tend to get a rally. So that's the good news. Sometimes you get some volatility leading up to the election. Usually the next day, boom, the market takes off and finishes the year strong. Now, under the hood, though, different sectors of the economy and different sectors of the market will do better depending on who won and what that mix looks like. To give you just kind of a broad example, typically healthcare might do better, if one party wins than the other, because there could be, different views on how government involvement in healthcare. Energy, for example, tends to do better when the Republicans are in power because the perception is they're more, oil friendly. So under the hood, you'll see different leadership depending on who wins. In general, markets tend to like divided government. As I mentioned a moment ago, markets don't like uncertainty. And if either party has complete control of government, that's actually maximum uncertainty because they can actually do stuff, right? Things actually happen, things actually change, and the market doesn't know what's going to actually come next. In any kind of divided government scenario, you typically, frankly, don't get major changes. And markets tend to like that because, for better or for worse, at least they know the current environment, they know the rules, they know nothing's going to change. I think right now, I would suspect just about any prognosticator would suggest there's a good chance we end up with divided government. That's the most likely outcome at the end of the year. So specifically from a stock market perspective, that's probably a good thing. And my expectation would be that you'll get a nice rally in the market after that election.
Perfect. Thank you for that. That's all that I have for questions here, unless you have anything on your end, Greg?
I don't know. Any other slides there, Dan, or are you kind of wrapping up here on our end there?
Yeah.
Yeah, no, unless if you have any additional questions, feel free to continue to send those in to Logan through here, or you can message any of us here in the office. Everyone here's kind of tuned in here this evening, and any kind of feedback. We'd love to hear from all of the folks, the attendees tonight, if there's things that we can answer for you, and if we can't answer, we can reach out to Dan and his team to get answers for you. With that, Dan, I'd like to thank you for taking your time this evening and spending time with us here in the Midwest, and yeah, just kind of going through a lot of the questions, that we all have the market outlook and questions about midterms and volatility. It's been a very, very volatile market, and it's the old saying, time in, not timing. This market we've seen, if you look back to COVID and up until now, we've seen such significant swings that I think it's more folks are getting accustomed to these big swings that are 3 and 2 and 4% swings, up and down week to week. It's just been very volatile with all the uncertainty, and it's back to the basics, right? It's making sure we get enough money for the short term, and if it's long-term money, and having a well-diversified, disciplined strategy, and not trying to go time some of these things and jump in and out. So again, thank you, Dan, for your time. Again, folks, thank you for tuning in. We'd love to hear any feedback, and we will kind of keep you posted. We look to continue to bring these types of events and content to clients kind of going forward here in the coming months, and we'll kind of continue going forward. So with that, we'll wrap the call up. And again, thanks again, Dan and Logan, and everybody have a good evening, and we'll talk again here soon. Thanks, guys.
Thanks, guys. Appreciate it.
Bye-bye.
All right. Bye-bye.